Good morning, it's Jeff Christian. It's about 11:30 in the morning on December 2nd, the Friday. I'm going to talk about what happened with gold and silver prices this week and what didn't happen. I had hoped to talk about silver inventories, but I think that given the sharp increases in gold and silver prices in the last 2 days, Wednesday and Thursday, and then the decline this week warrants more attention in probably the minds of some of our viewers. So that's what I'm going to talk about. And related to that will be the economy. First off, there should have been no surprises. 3 factors were behind the rise in prices over the past 2 days. You could say there's a 4th factor, which is the fact that the prices have been very low over the last several months. But the first big factor behind the increase in prices over the last 2 days was an expectation in financial markets, especially in gold and silver, of a slowing of the rate of increases in interest rates. Not a pivot to lower rates, but a slowing in the increase in the rate of increase. Now, that shouldn't have been a surprise. It's nothing new. It just confirmed what the broader financial markets have been saying for some time. We often refer to the CME's FedWatch tool, where you can see where the market consensus is and the spread of opinions as to future increases in the Fed funds rate by the Federal Open Market Committee. And you can see that the broader financial markets have been expecting a slowing down, a smaller increases in interest rate hikes about this time for about 6 months, maybe longer. Actually, I think longer. If you go longer term, they thought that we'd be in the pause phase right now. Current consensus, which has been around for a while, is that we'd see a 50 basis point increase in December and maybe some 25 basis increases into March. And then after that, you'd see a long plateauing of interest rates. No more increases, but not necessarily decreases until late in 2023. And I believe the most recent FedWatch percentages is that an expectation of 25 basis point declines in the Fed funds rate starting next November and December. So what we saw with Chairman Powell's comments and the market reaction to them was a confirmation that the Fed funds rate will continue to rise, but at a somewhat slower pace. But that was a very big, exciting piece of news to people in the gold and silver markets, it seems, even if the broader financial markets had fully expected it already. The second factor was signs of declining inflation rates. Again, nothing new, just confirming trends that have been emerging really over the last 4 months and that mainstream economists have been saying to expect really for the last 12 months over the latter part of 2023. So again, no surprises, but confirmation of what's going on. And maybe it surprised some of the silver and gold bulls that don't necessarily pay to the real world, attention to the real world. It's not hard to say. And the third factor was the December roll in COMEX gold and silver futures contracts. It occurred. It occurred over the last 3 days, the 29th, 30th of November, 30th of November being the first delivery date for the December contracts, and December 1st. It's continuing today. There was no crises. Some people had predicted it. No one should have expected it. What we saw was a pretty much standard roll in the contract going forward. Now, I'm going to talk about the overall economy in a minute, but what we're seeing is stronger industrial production figures coming out for the United States and for other countries. stronger consumer spending figures coming out yesterday for the United States and for other countries, and stronger employment figures coming out today for the United States. The outlook for GDP in 2023 and beyond, the market consensus is that you will probably see very weak growth in the United States and in other countries, recessionary conditions in some European countries in 2023, but that a more significant recession probably lies beyond 2023. I think last week I mentioned that the OECD's most recent projections are that we might see negative 0.1% contractions in the US economy in 2 quarters next year, and then growth on either side of that. So that is technically the definition of a recession, but it's within the margin of error, negative 0.1%. So basically very low to flat growth, but continuing to grow. And those strong industrial production, consumer spending, and employment figures, as well as non-residential construction and other factors, continues to show or point to continued strength. All those problems that we talked about last week are still there, but they're a little bit more distant on the horizons. Now, what didn't happen this week? There was no run on December silver. There was no massive need for hundreds of millions of ounces of physical silver, as some of the silver bugs were predicting, due to the maturity of silver index paper derivatives that have in their offering memoranda that they would be settled for cash, not for physical metal. Those derivatives didn't distract investors from physical silver. The investors who buy silver index notes want to buy and do buy exposure to silver prices through derivatives. They do not want to buy physical silver. They probably would not buy physical silver if the derivatives didn't exist. So they're not actually having a negative effect by distracting investors away from physical silver. They're not physical silver investors. They're investors in price exposure to silver. And many of them lost money due to the decline in silver prices since they bought those silver index notes. There's no massive withdrawal of silver from COMEX depositories, as had been predicted by some of the silver bugs. In fact, registered silver volumes actually increased 2.8 million ounces on the first delivery day. And most of the December open interest that people were saying you should be worried about because there wasn't enough silver to take delivery, to deliver into, was rolled forward into the March contract. And that, again, should not surprise anyone because that's what happens month after month in the futures markets. Not the futures silver market, not the futures gold and silver markets, in futures markets across commodities. You see open interest in a nearby active contract, and as that contract approaches first delivery day, most of that open interest rolls forward because it's not a matter of seeking physical delivery, it's a matter of wanting exposure to the commodity price. In terms of open interest, as of yesterday, there's 538.8 million ounces of open interest in the March contract. And December open interest had dropped down to about 14.1 million ounces of open interest. So there's 14.1 million ounces as of yesterday to be resolved, either delivered into, some of it will be delivered into, probably less than 1% of what was around, and most of it will be rolled forward or simply closed out. Let's talk about the markets because, as I said, we did see prices rise. Gold got up to 1820. It's backed off today, possibly partly in reflection of investors sort of reevaluating the outlook for precious metals in light of a stronger jobs report than had been predicted by financial analysts. Gold got up to 1820. It's backed off. It got down as low as 1791. And as I'm speaking, I believe it's back up to around 1801. Silver got up to almost $23, maybe a little over $23. Came back off a little bit this morning to about $22.50. And as I'm speaking, I think it's back above $23. So you're seeing these prices. But if you look at these charts, you can see what you're seeing is we're now moving out of that lower period that we've seen in gold prices, really starting around May or June of this year, and in silver starting a little bit earlier. And we've had this longer period of time of prices consolidating, and now they're testing the upper end of those lower ranges. And we'll see how it shakes out. Our expectation at CPM Group is that the prices will continue to move upward in a very modest basis. But I think there's going to be some struggling over the next few months in terms of that. And it's not going to be a sharp pace. You're not going to see $28 or $30 silver in the near future. And you're not going to see $2,000 gold in the near future. But you will see prices stabilize and continue to move upward. We don't subscribe to the theories that, I don't know if they're even theories. There are people talking about, $1,500 or $1,300 or $1,000 gold. We don't understand where those numbers come from. In early 2013, the price of gold had come off. It was trading around 1680, 1620, 1580. And there was one company that likes to, or it's gone for all intents and purposes now, but they like to see themselves as our competitors in terms of real fundamental gold and silver research. Did a terrible job. They had two people who were sort of in charge of being their figureheads. And in early 2013, one of them was predicting in the press and interviews that he thought the price of gold would go over $2,000 in 2013. The other person was saying that he thought that the price would fall to $1,000. Being the wag that I am, somebody asked me, what I thought of that company having two quite different projections. I said, well, I guess they want to be right. One of them they think that one of them will be right. But our view at CPM Group in early 2013 was that both would be wrong. We did not see the price of gold rising over to $2,000 or higher for several years. In 2013, we were projecting a 3 to 5 year decline in gold prices, followed by a rise in prices after 5 years, 2018. Oh, let's look at that chart. That's cute. Yeah, we got that one right. We also were saying we did not see the fundamental basis for prices falling below $1,200 or $1,300. We got that right too. In the end, they were both wrong. We tend not to subscribe to wild projections for higher or lower prices that cannot be justified based on the fundamentals and the elasticities of the fundamentals of supply and demand as accurately measured in these markets. We look at the fundamentals of supply and demand. We parse them. We look at the elasticities of mine production, secondary recovery, fabrication demand, jewelry demand, investment demand, central bank demand, and we put that all together and it helps us understand what are reasonable expectations for rising and falling gold prices, as well as every other commodity that we work on, from silver and platinum and palladium and rhodium to iridium and ruthenium, manganese, molybdenum, tantalum. That's how we estimate the markets, looking at the fundamentals and looking at the macroeconomic world, all with a sober mind. We don't wave our arms and talk about the collapse of the stock market or other factors. We talk about what's really going on and what's a likely probability of future economic trends. So let's look at those a little bit. Overall economic growth plugs ahead. We saw 2 quarters of negative growth in the first half of of 2022 in the United States. 2022 third quarter growth has been positive in terms of its initial reports. The final report, I guess, estimate will come out later this month. As I said earlier, going forward, we're looking for some continued growth in overall economic activity, i.e. gross domestic product, in the course of 2023, but very low. Same is true on a global basis. U.S. GDP, looking at it as a level in billions of dollars as opposed to percentage change year ago, you can see it's still very high. A significant recession will occur. You should keep waiting for it. It's probably not going to occur in 2023. We might have 2 quarters of negative growth, but it's going to be relatively mild, or so it looks at this point. That can change in any number of ways for any number of factors, but at this point it looks like we're just going to see a continuation of low growth over the course of 2023, not tipping into a major recession in that year. If you look at industrial production, it remains strong. Yeah, we had this big spike up after the big spike down, the recovery after the lockdown. But if you look at industrial production figures compared over the last several quarters, you can see that they're higher than they've been really since prior to 2000, really the 1990s, when you see industrial production growth rates where we're seeing them now. So it doesn't look like we're tipping into a recession anytime soon based on that. And the same is true with consumer spending. It remains high by historical standards. You can go way back to find where we've seen consumer spending growth rates this high. So there are indications that we're not imminently headed toward a recession. CPM Group continues to project a recession in the industrialized countries probably in 2024, 2025. I've been saying that. We're a broken record. I'm sorry. The dollar, let's put the decline in November in perspective. It has fallen sharply on a trade-weighted basis and against some of the major traded currencies. And it remains higher than it has been since really the middle of 2022. So we've seen it come down, but it's still high by historic standards, definitely high by early 2021 standards or even late 2021 standards or 2019 standards. Even 2022, it's high by that standards. And if you put it into a longer term perspective, you can't even see the November decline in this chart. There was a small decline in the monthly average basis from October, I'm pretty sure. But it was inconsequential from a longer term perspective. Another set of assets to look at are the equity markets. And we've seen the equity markets weaken along with gold and silver and commodities and bonds and other currencies, non-dollar currencies. And we've seen them recover over the last few days as well. I like the S&P 500 because it's an index of 500 stocks. The Dow Jones is 29 stocks or whatever it is. It's a much smaller pocket. But you can see that the Dow Jones has done better than the S&P over the course of this year. Both of them are down. The Dow Jones has recovered more than the S&P. The S&P, which reflects a broader swath of the U.S. economy and the equity markets, remains lower relative to where it started the year, which was basically the historic peak. And then again, on a longer term basis, you can see, yes, we've seen big declines in the stock market earlier this year. Dow Jones is recovering handsomely. S&P is lagging it in the recovery. But look at that in comparison to anything prior to 2021. That's about all I've got for now. Take care of yourself. Have a good weekend. Take care of people around you and try to take care of the world because it really needs a lot of help. We'll be back next week and we'll talk about more about the fundamentals of the precious metals market.